Hey everyone, welcome to our Wealth for You channel. Today, we're diving into the ultimate guide to finding dividend stocks that pay big, a powerful way to grow your wealth and earn passive income. I'll walk you through everything you need to know, from picking the right dividend stocks to looking out for red flags in investing. Let's get started on building a brighter financial future, one dividend at a time. Please like, share, and subscribe to get more of similar videos in the future. Today, we're diving deep into the world of dividend investing, specifically how to find dividend stocks that pay big for massive passive income. Whether you're a seasoned investor or just getting started, this video is going to cover everything you need to know to start building a portfolio that pays you regularly. If you're ready to make your money work for you, let's get started. So, first things first, what are dividends? A dividend is a portion of a company's earnings that it returns to its shareholders. Dividends are usually paid in cash directly to shareholders. These payments are usually deposited into the shareholder's brokerage or bank account. Cash dividends are often expressed as a fixed amount per share. For example, $0.50 per share or a percentage of the stock's market price, called the dividend yield. Dividends are usually paid quarterly, and they can be a great way to generate passive income. But not all dividends are created equal. To really make the most out of dividend investing, you need to know how to pick the right stocks. So, how do you choose the best dividend stocks? Here are the key factors to consider. Point number 1. Focus on sustainable dividend yield and a reasonable payout ratio. Point number 2. Prioritize financially healthy companies with consistent earnings and manageable debt. Point number 3. Look for companies with a history of stable or growing dividends. Point number 4. Understand the company's competitive advantage. Point number 5. Analyze cash flow and profitability. Point number 6. Use valuation metrics. Please like, subscribe, and press the notification button so that you will receive more exciting videos in future. Also, do let me have your comments on why dividend investing is the best strategy for passive income for you. So, point number 1. How do we evaluate sustainable dividend yield and a reasonable payout ratio? Dividend yield. This measures the annual dividend payment as a percentage of the stock's current price. While a high yield might seem attractive, it can also indicate risk. Extremely high yields could suggest that the stock price has dropped significantly due to underlying problems. Payout ratio. The payout ratio indicates the percentage of earnings paid out as dividends. It's calculated by dividing the annual dividend per share by the earnings per share EPS. A payout ratio between 40% to 60% is generally considered healthy. If a company has a payout ratio over 80%, it might indicate that it's paying out too much of its earnings, which could be unsustainable, especially during economic downturns. Number 2. So, how do we prioritize financially healthy companies with consistent earnings and manageable debt? Revenue and earnings growth. Look for companies with consistent revenue and earnings growth over several years. This growth demonstrates that the company has a solid business model and is likely to continue generating profits to support future dividend payments. For example, a company like Johnson & Johnson J&J has a strong history of steady revenue and earnings growth. Debt levels. Check the company's debt-to-equity ratio, which compares its total liabilities to its shareholders' equity. A lower ratio is generally preferred, as companies with high debt levels may face challenges maintaining dividend payments, especially if interest rates rise or economic conditions deteriorate. Number 3. So how do we look for companies with a history of stable or growing dividends? Dividend history. Look for companies with a strong track record of paying and increasing dividends over time. Companies that have consistently paid and raised dividends for many years are often referred to as dividend aristocrats or dividend kings. For example, Procter & Gamble PG has increased its dividend for over 60 consecutive years, reflecting strong business performance and commitment to returning value to shareholders. Dividend stability. Assess whether the company's dividend payments have been stable or growing during different market conditions. Stability in dividend payments indicates that the company's management prioritizes rewarding shareholders even during challenging times. Point number 4. How do we understand the company's competitive advantage? Moat analysis. A moat is a term used to describe a company's competitive advantage that protects it from competitors. Companies with strong brands, high barriers to entry, patented technology, or cost advantages tend to have wide moats. For example, Coca-Cola Co. has a wide economic moat due to its brand strength, global distribution network, and scale. A strong moat can provide more predictable cash flows, supporting consistent dividend payments. Industry position. Consider the company's position within its industry. Market leaders are companies in sectors with stable demand, such as utilities or consumer staples, often have more reliable revenue streams, making them good candidates for dividend investing. Number 5. Analyze cash flow and profitability. Free cash flow, FCF. Free cash flow represents the cash a company generates after accounting for capital expenditures. A company with strong free cash flow has more flexibility to pay dividends, repurchase shares, or reinvest in the business. Review the company's cash flow statements to ensure it generates enough cash to cover its dividend payments comfortably. Return on equity, ROE. ROE measures a company's profitability relative to shareholders' equity. A higher ROE indicates that the company is efficient in generating profits from its equity base. Companies with consistently high ROE, like Microsoft MSFT, often have strong management and business models capable of supporting dividend payments. Number 6. Use valuation metrics. Price to earnings, PE. Ratio. This ratio compares a company's current share price to its earnings per share. A high PE might suggest that the stock is overvalued, while a low PE might indicate it is undervalued. However, it's important to compare PE ratios within the same industry, as different sectors have different average PE levels. Dividend Discount Model, DDM. For advanced investors, the DDM can be used to estimate the value of a dividend-paying stock by discounting its future dividend payments to the present value. This model assumes that the dividends will grow at a constant rate, making it a useful tool for evaluating whether a dividend stock is fairly valued. Have you learned how to select good dividend stocks? Do type your comments on how you have learned today, and I will reply you. While it is exciting to look for good dividend stocks, do also look out for red flags when picking dividend stocks. If a company's stock price is dropping, while its dividend yield is high, it could be a sign that the market expects future dividends to be cut. A payout ratio over 100% means the company is paying out more than it earns. That's not sustainable in the long run. A company that frequently cuts or skips dividends is not a reliable source of passive income. Finally, building your dividend portfolio. Diversify across sectors. When building a dividend portfolio, think about diversification. Don't put all your eggs in one basket. Spread your investments across different sectors and industries to reduce risk. Regularly reinvest. Dividends. Use a dividend reinvestment plan. DRIP to automatically reinvest your dividends into purchasing more shares of the companies you own. This strategy takes advantage of compounding, helping your portfolio grow faster over time. Monitor and rebalance. Regularly review your portfolio to ensure it aligns with your goals. Monitor for changes in company fundamentals, dividend cuts, or shifts in market conditions, and rebalance as needed to maintain diversification and desired income levels. Stay patient and disciplined. Building a dividend portfolio takes time. Stay patient, focus on your long-term strategy, and avoid reacting to short-term market volatility. By following these steps, you can build a well-balanced dividend portfolio that provides reliable income and growth potential over the long term. Conclusion and call to action. All right, that's it for today's video. Picking high dividend stocks is a great way to build massive passive income, but remember, it's essential to do your research and stay informed. If you found this video helpful, make sure to hit that like button, subscribe to the channel, and ring the bell so you never miss an update. Please let me have your comments below if you have any questions or if there's a topic you'd like us to cover next. Sharing is caring. Thanks for watching, and see you in the next video.